Every time you take a trade because something is moving without you, you are paying a tax on your ignorance. Not market ignorance, your ignorance of yourself. You are funding the accounts of traders who waited while you are reacting to price that has already moved, to momentum that is already exhausted, to a setup you did not plan for and cannot manage. FOMO is not just an emotion you experience, it is a systematic transfer of capital from reactive traders to patient ones, and you are on the wrong side of that transfer every single time you act on it. This is not happening occasionally, this is happening every single session you trade. Every time you see price move and you feel that squeeze in your chest, that urgency, that voice telling you to get in before it is too late, you are about to make a transaction that mathematically favors someone else. The trader on the other side of your entry is not experiencing FOMO. They planned this trade hours ago, maybe days ago. They have been waiting for price to reach this exact level. They knew you were coming. They knew reactive traders would see the move and chase it. Your entry is their exit. Your urgency is their profit. Most traders believe FOMO is a discipline problem. They think if they just had more willpower, more rules, more accountability, they could resist the urge to chase. They write trading plans that say things like "do not chase" and "wait for confirmation" and "stick to your setups." Then they watch price move without them and they take the trade anyway. And they blame themselves. They think they are weak. They think they lack the character to be a good trader. But FOMO is not a discipline problem. It is a knowledge problem. You chase setups you do not understand because you have not trained your brain to recognize the only setup that actually belongs to you. You react to other people's opportunities because you have not built deep enough pattern recognition in your own. The belief that you can resist FOMO through willpower alone is the reason you keep experiencing it. Willpower is a finite resource that depletes throughout the day. You wake up with a full tank. Every decision you make, every impulse you resist, every temptation you avoid drains that tank. By the afternoon, by the evening, your willpower is empty. That is when you take the worst trades. That is when FOMO wins. Pattern recognition is automatic, instant, and does not require effort once it is installed. It does not drain your willpower. It bypasses the need for willpower entirely. When you see your pattern, you do not have to resist the urge to trade other things. You do not see other things. Your brain has been trained to filter them out. You are trying to solve a software problem with hardware that was never designed for the task. Here is what actually happens when you experience FOMO. You see price moving. You recognize motion but not structure. Your brain knows something is happening but cannot classify what type of event this is, whether it fits your framework or what the probability of continuation is. In the absence of deep pattern recognition, your brain defaults to a different system entirely, the limbic system, the ancient part of your mind that interprets uncertainty as danger and motion as urgency. This system evolved millions of years ago to keep you alive. When a predator moved in the peripheral vision of your ancestors, hesitation meant death. Action, even imperfect action, was better than analysis. That same system is still operating in your brain right now. It sees price moving and it interprets that motion as a threat to your survival. Not your physical survival, but your financial survival, your status, your identity as a trader. It sees other traders making money, interprets your inaction as falling behind, and triggers a chemical cascade designed to make you move. Cortisol rises, your heart rate increases, your perception of time compresses. You feel like the opportunity is vanishing. You feel like every second you wait is a second of profit lost. This feeling is real, but the opportunity was never yours to begin with. You are chemically incapable of making good decisions in this state, and the market does not care. The market does not adjust to your emotional state. It does not slow down so you can catch up. It rewards the traders who are not in this state, the traders who planned their entry before emotion arrived, and it punishes you for entering from a place of panic. Paul Tudor Jones started with $10,000 in the late 1970s. By the late 80s, he had turned that into over $100 million. He traded one macro setup, trend reversals at major support and resistance after extended moves. He did not trade breakouts. He did not trade consolidations. He did not trade momentum continuation. He did not trade range-bound, choppy markets. He waited for markets to overextend, for sentiment to reach extremes, and for technical structure to show exhaustion. Then he took the other side with size. When asked why he did not trade other setups, he said he did not need to. He had seen his pattern thousands of times, across commodities, across currencies, across indices. He knew when it was forming, when it was likely to fail, and how to manage it once he was in. He knew what the price action looked like 2 days before the reversal. He knew what volume looked like at the turning point. He knew how sentiment read in the news and in the positioning data. He knew all of this because he had lived inside this one pattern for years. Everything else was noise. Everything else was someone else's trade. He was not afraid of missing out because he had trained himself to see only the setups that belonged to him. Everything else was invisible. That is not discipline. That is pattern recognition so deep that other opportunities do not register as opportunities at all. And here is the critical part. Jones did not sit at his screen every day taking trades. He has talked about this in interviews. There were weeks where he did nothing, entire weeks. He was watching, he was analyzing, he was waiting, but he was not trading because his setup was not there. He was not bothered by this. He was not worried that he was missing out on other opportunities. He knew his edge only appeared under specific conditions, and he was willing to wait for those conditions no matter how long it took. That patience was not a personality trait. It was a byproduct of certainty. When you know your edge, when you have repped it enough to trust it completely, waiting becomes easy. It is not a test of character. It is a logical choice.
Think about a chess grandmaster looking at a board. They do not analyze every possible move. They do not consider every piece. Their brain has been wired through tens of thousands of games to recognize patterns instantly. They see a configuration and they know within 2 or 3 seconds what the best move is. Not because they calculated it, because they have seen this structure before, in slightly different forms, enough times that recognition is automatic. Research on chess expertise show that grandmasters do not have better memory than amateur players. They have better chunking. They see clusters of pieces as single units. Where an amateur sees 8 individual pieces in various positions, a grandmaster sees 2 or 3 strategic patterns. Their brains have compressed thousands of hours of experience into a handful of recognizable templates. This is not magic. It is pattern recognition built through repetition. A beginner looking at the same board sees pieces. They see options. They see complexity. The grandmaster sees 1 or 2 relevant patterns, and everything else fades into background noise. Now put both players in a blitz game where each move must be made in under 5 seconds. The beginner falls apart. There is no time to calculate, no time to weigh options. They make random moves, panic moves, moves that feel right in the moment but destroy their position 3 moves later. The grandmaster plays faster and better because they are not thinking, they are recognizing. Their hand is moving before their conscious mind has fully processed what they are doing. This is the difference between unconscious competence and conscious incompetence. When you chase a trade because of FOMO, you are the beginner in a blitz game. You are taking action without recognition. You are moving because the clock is running, not because you see the pattern. And just like the beginner who makes a move that looks good but is actually catastrophic 3 moves later, you are entering a trade that feels like opportunity but is actually the beginning of losing sequence. The market does not wait for you to think. Execution happens in seconds. The difference between a profitable entry and a losing one is often a few ticks, a few seconds of hesitation, a slight misjudgment of timing. Traders who have repped their setup 500 times do not hesitate. They see their pattern, they know it is valid, and they execute without internal debate. Their brain has automated the decision. There is no voice in their head asking if this is really the right time, if they should wait for more confirmation, if maybe this is a trap. That voice has been silenced by repetition. They have taken this trade so many times that they know at a cellular level what comes next. Traders who are studying 10 different setups, learning new concepts every week, collecting strategies from different traders, do not have this automation. Every potential trade requires conscious evaluation. Is this setup A or setup B?
Does this fit the rules I learned last month or the new rules I learned last week? Should I take this or wait for something cleaner? By the time they decide, the trade is moved. Then they see it working without them, and FOMO takes over. They enter late, they enter emotionally, and they enter a trade they cannot manage because it was never part of their trained pattern set. This is not a failure of discipline. This is the inevitable result of shallow repetition across too many strategies. You cannot build unconscious competence by spreading your reps across multiple frameworks. You can only build it by concentrating your reps in one place until that one thing becomes as natural as breathing. Compare two traders. Trader 1 has studied one price action setup for 2 years. They have taken it 200 times in live markets. They have backtested it across 500 additional examples. They have watched it form and fail hundreds of times. They know exactly what it looks like in a trending market, in a ranging market, in high volatility and low. They know the subtle differences between the valid version and the trap version. They know that when price approaches the level with a certain type of momentum, the setup has an 80% success rate. But when price approaches slowly with multiple retests, the success rate drops to 40%. They know this not from someone telling them, but from having tracked the data themselves over hundreds of examples. When they see their setup forming, they recognize it in under 3 seconds. They already know their entry, their stop, their target. They place the trade, set their alerts, and walk away. Emotions do not enter the equation because the decision was made long before this specific instance appeared. If the trade wins, they feel nothing. If it loses, they feel nothing. They are trading probabilities, not outcomes. Trader 2 has studied 10 setups. They have taken each one maybe 20 or 30 times. They understand the theory behind all of them. They can explain why each one works. They can draw examples on a chart. But when they look at a live chart, they see 10 possible opportunities. Maybe this is a breakout setup. Maybe this is a retest. Maybe this is a trap that fits that reversal pattern someone posted last week. Every decision point becomes a negotiation, a cost-benefit analysis performed in real time under emotional pressure. Even if they make the right decision, they make it slowly, and slow decisions in fast markets become wrong decisions. But the deeper problem is what happens after they take a trade. Because they have not repped the setup enough, they do not know if it is supposed to behave. They do not know if this pullback is normal or if the trade is failing. They do not know if they should add to the position or cut it. Every minute they are in the trade, they are guessing. And when you are guessing, you exit too early or too late. You take profit at the first sign of heat. You hold losers too long, hoping they come back. The setup itself might be valid, but you cannot execute it properly because you haven't lived inside it long enough. This is why edge in theory does not translate to edge in practice. Execution is everything, and execution requires depth.
Intelligence does not solve this. Smart traders fall into the same trap. They believe that because they understand the logic of a setup, they can trade it. But understanding is not execution. Execution is physical. It is a trained response that bypasses the part of your brain that wants to deliberate. You do not become a surgeon by reading about surgery. You do not become a pilot by studying aerodynamics. You become competent through repetition under real conditions until the action is automatic. A medical student can explain how to perform an appendectomy. They can describe the incision, the tools, the technique, but put them in an operating room and hand them a scalpel and they will freeze. Their knowledge is intellectual, not embodied. A surgeon with 500 procedures does not freeze. They cut. Their hands know what to do before their mind catches up. Trading is no different. The trader with 500 reps on one setup will outperform the trader with 50 reps on 10 setups every single time, regardless of IQ, regardless of how many books they have read, regardless of how well they understand market structure. Reps are everything. Concepts are nothing. You can have the best strategy in the world, the most sophisticated understanding of market mechanics, but if you have not repped it enough to execute it without thinking, you do not have an edge. You have theory, and theory does not pay. Now, let us walk through what actually happens in your mind when you are looking at a chart and you are trying to trade multiple setups. Price is consolidating near a key level. You recognize this could be a breakout setup, but you also know that most breakouts fail, and there is a reversal setup that someone you follow trades when price reaches these levels and gets rejected. You wait. Price breaks higher. Your breakout setup is triggering, but you hesitate because you are not sure if this is the strong kind of breakout or the kind that traps early buyers. You remember that someone said you need to see a retest before entering, but you also remember that someone else said the best breakouts do not retest. While you were evaluating, price moves another 10 ticks. Now you're late, but it's still moving. Maybe there is still edge. You tell yourself you will wait for a pullback. Price continues higher without pulling back. Now you are watching a move that is working exactly like your breakout setup was supposed to work, and you are not in it. The FOMO starts. Your chest tightens. You can feel the opportunity slipping away. You can see the profit you should have made. Every tick higher is a tick of lost money. This is not rational, but it feels real. You enter, not on a signal, not on a plan. You enter because you cannot stand to watch it move without you anymore. 2 minutes later, price reverses sharply. You are stopped out. You watch as price falls back into the range and then breaks lower, triggering the exact reversal setup you were thinking about earlier. Now you feel like an idiot. The opportunity was there twice. You missed the first one because you were not sure which setup to trade. You took the second one too late because FOMO overrode your judgment, and now you're down money and mentally fractured. This is not a lack of skill. This is what happens when your brain is trained on too many patterns and cannot choose between them under pressure. You were trying to trade two different edges, and you ended up trading neither. You traded emotion. Let us go deeper. You take a trade on setup A, the one you learned 3 months ago. It starts moving against you. Immediately, your brain begins searching for reasons to justify the loss or adjust your behavior. Maybe I should have used setup B instead. Maybe this is not really setup A. Maybe I entered too early. Maybe the market regime has changed and this setup does not work anymore. Because you have not repped this setup enough, you do not trust it. You do not have the internal database of wins and losses that tells you this drawdown is normal, that the setup still has a 70% win rate even when it does this, that you should sit tight. Instead, you exit early. You take a small loss that did not need to happen. Then you watch the trade reverse and go on to hit your original target without you. Now you're angry. Not just angry at the market, angry at yourself. You feel like a stupid. You feel like you're never going to figure this out. And underneath that anger is something worse, shame. You feel like you do not have what it takes to be a trader. The next setup appears. You're still angry from the last trade, still questioning whether you should have stayed in, still feeling like you were behind. This next trade is not your best setup. It's not even your second best, but you take it anyway because you need to make back what you just lost. You need to prove to yourself that you can execute properly. You are not trading your edge anymore. You are trading your emotion. And emotional trades don't just lose money, they create a loop. Loss leads to frustration. Frustration leads to revenge trading. Revenge trading leads to larger losses because you're taking worse setups with worse risk management. Larger losses lead to desperation. Desperation leads to complete abandonment of your plan. By the end of the session, you were taking trades that don't even resemble anything you studied. You are clicking buttons because price is moving and you feel like you should be involved. This cascade started because you took a trade on a setup you hadn't mastered. If you had 500 reps on that setup, you would have known the drawdown was normal. You would have known that the setup produces a certain amount of heat before it works. You would have held. You would have taken profit at your target and moved on. No emotion, no revenge, no cascade. The difference between the profitable trader and the unprofitable one is not intelligence or knowledge or even discipline in the traditional sense. It's emotional neutrality. And emotional neutrality only comes from certainty, and certainty only comes from reps.
You need to understand something about edges. They do not exist in all conditions. An edge is not a universal truth. It is a probabilistic advantage that only appears under specific market regimes. Trend-following setups work in trends. They lose money in ranges. This is not controversial. Everyone knows this, but knowing it intellectually and knowing it experientially are completely different things. When you have repped a trend-following setup 500 times, you know, without having to think about it, what a trending environment looks like. You can feel it. You can see it in the way price moves, in the way it respects certain levels, in the spacing between highs and lows, and more importantly, you know what it does not look like. When the market transitions from trending to ranging, you see it immediately, not because you are analyzing higher time frame structure or calculating ATR or checking some indicator. You see it because your pattern is not appearing anymore. The structure that signals your edge is absent, so you stop trading. You do not feel FOMO when price chops around in a range. because you know that is not your market, that is someone else's market. Breakout setups work when volatility is expanding. They lose money when volatility is compressing and price is chopping. Mean reversion setups work when price is oscillating around a value area. They get destroyed in strong directional moves. If you are trading all three of these, you are guaranteed to be trading outside your edge at least 2/3 of the time. You are taking trades in conditions where your setup does not work, and you are doing it because you do not want to miss out on being active. But activity is not profitability. Most professional traders are inactive most of the time. They are waiting. They are watching for their specific condition, their specific regime, their specific structure. When it appears, they attack it with size and confidence. When it is not there, they do nothing. This is not because they lack other skills. This is not because they have not studied other setups. It is because they know that trading outside their edge is statistically identical to gambling. It might work occasionally, you might get lucky, but over time, over hundreds of trades, the math catches up, and the math says you lose. Let me be more specific. Imagine you trade a momentum continuation setup. Your edge appears when a market is already trending, when volatility is moderate to high, and when price is making clean higher highs and lower lows with pullbacks that do not violate structure. That is your condition. Maybe that condition exists 20% of the time. The rest of the time, the market is ranging, chopping, reversing at extremes, or in a low volatility grind where continuation setups fail more often than they work. If you take your setup outside that 20% window, you are not trading your edge, you are hoping, and hope is not a strategy. But if you are also studying and trying to trade range-bound setups, breakout setups, and reversal setups, you are now trying to identify 4 different regimes in real time and switch between 4 different execution frameworks depending on what you think the market is doing. This is cognitively impossible to do well under pressure. You will misidentify the regime. You will take the wrong setup for the condition. You will enter a breakout setup when the market is actually range-bound and about to reverse. You will enter a mean reversion setup when the market is actually trending and about to continue. You will exit trades early because you are not sure if the condition has shifted. And worst of all, you will experience FOMO constantly, because every time price moves in a way that does not fit your current setup, you will wonder if you should be trading something else. Your brain will be split. Part of you will be looking for your trend setup. Part of you will be looking for range setups. And when the market moves, you will not know which part to listen to. This internal conflict is exhausting. It drains your mental energy, and it prevents you from ever reaching unconscious competence in anything. Stanley Druckenmiller made billions. He did not trade every day. He did not take every opportunity. He said, and this is exact, that he waited for moments when he knew he was right, when all of his analysis lined up, when the trade was so obvious that not taking it would be irrational. He said those moments came maybe 5 or 10 times a year, not 5 or 10 per day, per year. He was not scalping, he was not day trading, he was not trying to capture every swing. He was waiting, and when his moment appeared, he bet large. Waiting was not a weakness, it was his strategy. It was the reason he could take large positions with conviction. Because he had seen his setup so many times, because he had studied so many historical examples, because he had lived through enough cycles, he trusted it completely. That trust only comes from depth, not breadth, and that trust is what allows you to size up. Most traders cannot size up because they do not trust their edge. They do not trust it because they have not repped it enough. So they take small positions, they exit early, and they never make meaningful money even when they are right. George Soros broke the Bank of England with one trade. One. He did not need a dozen setups. He saw a structural imbalance, a mispricing so severe that the only logical outcome was a collapse in the British pound. The British government was trying to maintain a currency peg that was unsustainable given the economic fundamentals. Soros recognized this. He built a position over time, he waited for the moment of maximum pressure, and then he pushed. That trade made him over $1 billion. He was not afraid of missing out on other currency trades. He was not worried that he should have been trading equities or commodities or anything else. He saw his edge and he took it. Everything else was irrelevant. That is the mindset of a specialist. The market will present you with infinite opportunities if you define opportunity as anything that moves, but it will present you with very few actual edges if you define edge as a condition where your specific skill set, your specific pattern recognition, and your specific execution framework give you a repeatable probabilistic advantage. Most of what moves is not an edge for you, it is an edge for someone else. Soros was not a generalist. He had deep expertise in macro currency dynamics. He had spent decades studying how central banks operate, how currency pegs work, how political pressure intersects with economic reality. When he saw the pound setup, he recognized it instantly because he had studied dozens of similar situations in history. He was not discovering something new, he was recognizing a pattern he had seen before. That is what mastery looks like. It looks like pattern recognition so deep that edge becomes obvious. This is where modern retail trading has completely derailed people. You see someone post about ICT concepts, order blocks, fair value gaps, liquidity sweeps, breaker blocks, mitigation zones, propulsion blocks. Someone else is posting about supply and demand zones. Another person is teaching Wyckoff accumulation and distribution. Another is showing you Elliott wave counts. Another is explaining smart money concepts and how institutions trap retail traders. Another is talking about market profile and value areas. Another is teaching you about VWAP and anchored VWAP. Another is showing order flow and footprint charts. Every single one of these frameworks has merit. Every single one of them works for someone, but they do not all work for you, and they certainly do not all work at the same time. The retail trader tries to absorb all of it. They watch dozens of traders, they join multiple communities, they subscribe to multiple services, they study concept after concept, and they end up with a mental database of trade ideas that is a mile wide and an inch deep. They can identify an order block, but they have not taken 50 live trades off order blocks, so they do not know which ones actually hold and which ones are just levels that look good in hindsight. They can spot a liquidity sweep, but they have not tracked 100 examples to know the difference between a sweep that leads to reversal and a sweep that leads to continuation. They can draw a fair value gap, but they do not know how to manage the trade once price enters the gap. They have the vocabulary, they do not have the reps, and without reps, they cannot execute. They see 15 possible setups on every chart, and they cannot choose between them, so either they freeze or they take the wrong one. Then they see another trader post about how they made money on the setup they did not take, and the FOMO cycle starts again. They think they are learning, they think they are expanding their knowledge, they are actually fracturing their ability to execute anything well. Here is what a specialist looks like in the modern context. They learn one ICT concept. Let us say they choose fair value gaps in trending markets. They do not learn order blocks. They do not learn breaker blocks. They do not learn mitigation zones. They learn fair value gaps. That's it. They backtest 500 examples, they take 100 live trades. They learn that fair value gaps work best when they appear after a strong impulse move in the direction of the higher time frame trend. They learn that gaps in consolidation are traps. They learn that gaps that get tested multiple times lose their edge. They learn how to manage the trade when price wicks into the gap versus when it fills it completely. They learn what a failed gap looks like within the first few candles. They learn how to identify when a gap is likely to fill versus when it is likely to hold and reverse price. They learn the difference between a gap that forms in isolation and a gap that forms near other structural levels. After a year of this, they can look at a chart and know within seconds whether the gap is valid or not. They do not need to think. They see it and they know. Every other concept that exists in the trading world is invisible to them, not because they are ignorant, but because they have made a deliberate choice to go deep instead of wide. And because they have gone deep, they do not experience FOMO when someone posts a winning trade off an order block. That was not their trade. It was never their trade. They do not feel like they missed anything because they only see the one pattern they have mastered. Their brain has been trained to filter out everything else. When they look at a chart, they are not scanning for 15 different setups. They are scanning for one. And when that one appears, they take it. When it does not appear, they wait. No internal conflict, no second guessing, no FOMO. Just execution.
Now, let us reframe the core belief that drives FOMO. You believe that more setups equal more opportunity. You believe that if you only trade one thing, you will miss too many trades. You believe that the way to make consistent money is to have multiple tools in your belt so you can trade all conditions. This belief sounds logical. It sounds professional. It sounds like something a sophisticated trader would say. It is completely wrong. More setups do not create more opportunity. They create more noise. They create more decisions. They create more internal conflict. And most importantly, they create more trades that are outside your actual edge.
You end up taking 50 trades per month with a 55% win rate and mediocre risk-reward because you are constantly switching between frameworks, constantly adjusting your rules, constantly second-guessing your execution. You are never fully committed to any one approach. You are dabbling, and dabbling does not produce mastery. A specialist takes 10 trades per month with a 70% win rate and excellent risk-reward because every trade is the same trade, same structure, same entry logic, same management, same decision tree. They are not smarter than you. They have not discovered a secret setup. They have simply repped one pattern so many times that they can execute it in their sleep. And because they can execute it perfectly, their edge actually materializes in their account. Your edge, if you even have one, is theoretical. It exists in backtests and in your head. It does not exist in your execution because you have not trained your execution to the point of automaticity. You are still thinking, and when you are thinking, you are losing. The belief that you need multiple setups comes from a fear that you will not have enough trades, but you do not need a lot of trades. You need a lot of reps on one trade. The trader who takes 2 trades per week off the same setup for 2 years will have over 200 live executions. That is more than enough to reach unconscious competence. The trader who takes 10 trades per week off 10 different setups for 2 years will have 100 executions per setup, and that is still not enough to reach mastery on any of them. Worse, they will have split their mental capacity across 10 different pattern recognition systems, and none of them will be automatic. They will still be thinking, still debating, still hesitating, and hesitation in trading is death. By the time you decide to take the trade, the best part of the move is over. You are entering at the middle or the end. You are entering when the smart money is exiting. This is why you keep getting stopped out on trades that look perfect on the chart. They were perfect 3 minutes ago. By the time you entered, they were already overextended, and you entered because you could not stand to watch them move without you. You entered from FOMO, not from edge, and FOMO entries are always late. Let me tell you what you are actually afraid of. You are not afraid of missing profitable trades. You are afraid of being inactive. Now, let us reframe the core belief that drives FOMO. You believe that more setups equal more opportunity. You believe that if you only trade one thing, you will miss too many trades. You believe that the way to make consistent money is to have multiple tools in your belt so you can trade all conditions. This belief sounds logical. It sounds professional. It sounds like something a sophisticated trader would say. It is completely wrong. More setups do not create more opportunity. They create more noise. They create more decisions. They create more internal conflict. And most importantly, they create more trades that are outside your actual edge. You end up taking 50 trades per month with a 55% win rate and mediocre risk-reward because you are constantly switching between frameworks, constantly adjusting your rules, constantly second-guessing your execution. You are never fully committed to any one approach. You are dabbling, and dabbling does not produce mastery. A specialist takes 10 trades per month with a 70% win rate and excellent risk-reward because every trade is the same trade, same structure, same entry logic, same management, same decision tree. They are not smarter than you. They have not discovered a secret setup. They have simply repped one pattern so many times that they can execute it in their sleep. And because they can execute it perfectly, their edge actually materializes in their account. Your edge, if you even have one, is theoretical. It exists in backtests and in your head. It does not exist in your execution because you have not trained your execution to the point of automaticity. You are still thinking, and when you are thinking, you are losing. The belief that you need multiple setups comes from a fear that you will not have enough trades, but you do not need a lot of trades. You need a lot of reps on one trade. The trader who takes 2 trades per week off the same setup for 2 years will have over 200 live executions. That is more than enough to reach unconscious competence. The trader who takes 10 trades per week off 10 different setups for 2 years will have 100 executions per setup, and that is still not enough to reach mastery on any of them. Worse, they will have split their mental capacity across 10 different pattern recognition systems, and none of them will be automatic. They will still be thinking, still debating, still hesitating. And hesitation in trading is death. By the time you decide to take the trade, the best part of the move is over. You are entering at the middle or the end. You are entering when the smart money is exiting. This is why you keep getting stopped out on trades that look perfect on the chart. They were perfect 3 minutes ago. By the time you entered, they were already overextended, and you entered because you could not stand to watch them move without you. You entered from FOMO, not from edge, and FOMO entries are always late. Let me tell you what you are actually afraid of. You are not afraid of missing profitable trades. You are afraid of being inactive. You are afraid that if you are not taking trades, you are not a real trader. You are afraid that sitting in front of a screen for hours and doing nothing means you wasted your time. You are afraid that other traders are out there grinding, taking trades, making money, while you are sitting idle. This fear is what the market exploits. The market does not care if you take trades. The market rewards correctness, and correctness comes from taking only the trades where you have trained yourself to recognize an edge. Everything else is a donation. You are paying the market for the privilege of feeling like a trader. You are paying for the emotional relief that comes from being involved. You are paying to avoid the discomfort of waiting. Stop paying. Start waiting. Waiting is not passive, it is active preparation. You are scanning for your pattern. You are confirming your bias. You are managing existing positions. You are reviewing your previous trades. You are sharpening your recognition. You are updating your understanding based on new data. And when your pattern appears, you act instantly and without doubt. That is what professionals do. They do not trade the market, they trade their edge, and their edge only appears sometimes. Most of the time, they are waiting, and they are comfortable waiting because they know that waiting is part of the edge. The edge is not just in the entry, the edge is in the patience to only take the entry when conditions are optimal. Here is what happens when you commit to one setup for a full year. Month 1 through 3, you are learning. You are identifying the pattern. You are taking trades and losing most of them because you do not understand the nuances. You are frustrated. You are questioning whether this setup even works. Month 4 through 6, you start to see consistency. Your win rate improves. You are beginning to recognize the difference between the high-quality version and the low-quality version. You are still making mistakes, but they are smaller mistakes. Month 7 through 9, you hit your stride. You are profitable. You trust the setup. You are starting to size up. You are experiencing less emotion because you have seen this pattern enough times that it is not surprising anymore. Month 10 through 12, you reach unconscious competence. You don't think, you execute. You see the setup and your hands are moving before your brain catches up. You are emotionally flat. Wins do not excite you. Losses do not bother you. You are trading probabilities. And somewhere in month 12, something changes. You stop seeing other setups as opportunities. You stop experiencing FOMO, not because you are disciplined, but because your brain has been rewired. You have trained yourself to see only one pattern. Everything else is noise. And when noise moves, you don't feel anything. It's just noise. That is mastery. That is what you are avoiding by jumping from setup to setup, concept to concept, trader to trader. You are resetting yourself back to month 1 every single time you switch. You never reach month 12. You never reach mastery. You stay in the learning phase forever, and the learning phase does not pay. You have a choice. You can continue doing what you are doing, studying new concepts every month, following multiple traders, trying to trade everything, taking 30 or 40 trades per month and wondering why you are not profitable, experiencing FOMO every time you see something move, feeling scattered, reactive, and always slightly behind, blaming yourself for lacking discipline when the real problem is that you are trying to do too much. Or you can choose one setup, one specific structure, one repeatable pattern. You can commit to repping that setup 500 times over the next year or 2. You can ignore everything else. You can unfollow the traders who post setups that are not yours. You can stop watching the markets that don't fit your framework. You can let other trades happen without you.
You can train yourself to see only your edge and to be blind to everything else. And at the end of that process, you will have something almost no retail traders have. You will have unconscious competence. You will have automatic execution. You will have emotional neutrality. You will stop experiencing FOMO because you will stop seeing other opportunities as opportunities. They will just be price moving in ways that don't fit your pattern. And when your pattern does appear, you will take it with full confidence, full size, and full conviction. You will not hesitate. You will not second guess. You will execute the plan because the plan has been executed hundreds of times before, and you trust it completely. That trust is the only thing that matters. Without it, you have nothing. With it, you have an edge. Everything else is noise.